LNG economy. And I would like to begin today's session by acknowledging that I'm joining from the lands of the Wurundjeri people of the Kulin Nation, and also to pay my deep respects to the traditional custodians of all the lands across Australia working to protect country. And today we are excited to walk you through our new Australian gas and LNG tracker and to discuss some of the trends that we are observing in Australia and our key export markets. This webinar will last for 1 hour. We will start with a presentation of some of the insights provided by the tracker by Josh Runciman. Josh is IEEFA's lead analyst for Australian gas, and he previously held a range of senior positions in government, including as a director on the ACCC's gas inquiry. And after Josh's presentation, we will have a curated Q&A session with two of our other gas analysts. And finally, we will have time to answer some of your questions. So please use the Q&A function and submit some questions to us. So now I will hand over to Josh.
Thanks, Amandine, and welcome everyone. Just bear with me while I share my screen. Amandine, if you could confirm that you can see those slides, that would be great.
Yes, we can see them now.
Okay, perfect. The presentation runs through some of the content on the Australian gas and LNG tracker, not all of it. So I would recommend that you jump on the IEEFA website and actually have a look at it. I'll run through where to find it on the website after I go through this. I guess as context, there's been quite a lot of debate in recent years around gas in Australia, the role of gas, and then also, I guess, the role of domestic gas versus exports. And really what I wanted to do with the tracker was just help to contribute to the evidence base to help inform this debate. So with that said, I'll dive into it. Bear with me, my slides do take a little bit of time to load, and this is just because of some of the functionality we have built into this. Okay, so Australia, many of you know, is one of the world's largest LNG exporters, and this is really on the back of a significant wave of LNG growth with a whole number of projects coming online from 2015 through till about 2019. This effectively saw a tripling in Australia's LNG production. Virtually all of our LNG goes to the Asian market. That reflects our proximity to Asia. But within that, about 90% of our LNG goes to just 4 countries. So our largest export market historically was Japan, followed by China. In 2024, that reversed and China overtook Japan to be our largest export market. South Korea and Taiwan are then our third and fourth largest markets. Interestingly, when we look at what has been happening in the past few years, we see that Australia's exports to both China and Japan have fallen. Japan's imports of Australian LNG have been falling for a while, but what we see with China is that our imports fell, particularly in 2022, and they haven't quite recovered. I'll dive into that in a little bit more detail as we go through. So looking at the Asian LNG market, what are the key trends that we're seeing? Well, what we're seeing is that demand is shifting from some of the traditional markets, notably Japan, into some of the more price-sensitive markets. And so what we see here on the chart is that Japanese LNG demand actually peaked in 2014, and it's fallen by about 25% over the past decade. In contrast, LNG demand in China has steadily increased, and it grew quite significantly from 2016 through to 2021. It did, however, fall quite materially in 22, and this really reflects the impact of high LNG spot prices. So Chinese importers tend to be price sensitive, particularly compared to some of the Japanese importers. Chinese LNG imports rebounded somewhat in 23 and again in 24. And while it's not shown in this chart, what we know about 2025 is that Chinese imports are down again, and Bloomberg are forecasting an 11% drop year on year. Then if we look at our other largest markets of Taiwan and South Korea, we can see that demand has been relatively consistent, particularly over the last 5 years. And then looking at some of the emerging markets, so South Asia and Southeast Asia, we see that South Asian LNG imports have been relatively stable, but again, um, fallen in 2022 due to high spot prices. So there really is that price sensitivity there. As spot prices have moderated, demand has rebounded somewhat, and 2024 represented a new high in terms of imports for South Asia. In Southeast Asia, we see that there has been pretty consistent growth, albeit off a low base, and Southeast Asian imports are still relatively low compared to imports in total across the Asian region. So if we do a bit of a deep dive into China, and just wait for my slides to come up, China is particularly important, both for Australia as our largest export market, but also for the global LNG industry as a whole. So LNG industry forecasts tend to point to China as the largest source of future demand growth. However, LNG imports in China do face competition from cheaper domestic production and cheaper pipeline imports. A lot of people realize or know that China is the world's largest LNG exporter. Not as many people know that China is also the fourth largest gas producer in the world and actually produces more gas than Australia does. What we see is that the share of LNG within China's supply mix remains fairly limited, and it has actually declined over the past 6 years. So in the first half of 2024, it was lower than in 2018. Generally, when you look at China's energy policy, what you see is that the Chinese government is now trying to take a more considered approach to gas demand growth, and then within that is also focusing on minimizing the cost of gas supply, hence an increased focus on domestic gas production and pipeline imports. So, what does this mean then for Australia? So, in addition to effectively seeking to limit reliance on LNG imports, China has also increasingly sought to diversify its LNG supply, including by securing supply from relatively cheaper sources. So, when we look at imports from Australia, what we see is that imports from Australia again grew on the back of Australia's LNG growth wave, peaked in 2021, and still have not recovered, sitting at about 85% of peak in 2021. Similarly, the share of Australian LNG within the Chinese LNG import mix has fallen as well. So it increased again on the back of the growth wave to 2019 and has been steadily falling since then. If we compare that to imports from Russia, Qatar, and the United States, we see that while there are some changes in the mix or the composition, we do see that imports collectively from those three regions have been growing quite steadily. And this just indicates some of the competition. Looking forward, we're likely to see large additions in LNG supply from Qatar and the US, and I would expect this trend to continue. Trade tensions are something to watch, of course. So if we take a step back from the Asian market in particular and look at the global market as a whole, the global LNG market, what are we expecting? So in our 2023 global LNG outlook, IEEFA projected a supply glut before the end of 2030. Before the end of the decade, and this is now a view that has been much more widely accepted. So this glut really reflects surge in LNG supply from a whole range of countries, led by the US and Qatar. Qatar is a particularly interesting one, given its LNG production costs are much lower than Australia's and actually much lower than any other supply globally. So in the next 5 years, the International Energy Agency, the IEA, anticipates close to 300 billion cubic meters of new LNG capacity. That's equivalent to about 220 million tonnes. And to put that into context, Australia's total LNG exports last year were about 81 million tonnes. So we are talking about a really sizable increase. The scale of this new supply is such that the IEA forecasts that this new supply, along with the existing supply, should be sufficient to meet global LNG demand out until 2040, even under its slowest transition scenario. This is the STEPS scenario, which is aligned with about 2.4 degrees of warming. The IEA also found that if we were to absorb all of this new supply, that would require one, LNG prices falling to about US $3 to $5 per MMBTU. That's about half the cost of new LNG supply. And then two, it would also likely displace renewable energy and energy efficiency, and it would slow the energy transition beyond that 2.4 degree outcome. So a looming global supply glut, what does that then mean for Australian producers? Well, the supply glut will emerge at a time when Australia's long-term LNG contracts, many of which were signed 10, 15, 20 years ago, start to expire. And so this chart shows Australia's contracted volumes. So this is not the number of contracts, it's the volumes under existing contracts. And then it compares that to Australia's liquefaction capacity. The difference here is of course, the difference between those. And so what we see is that the total volumes that Australian LNG producers are required to supply, and therefore have that price certainty over under existing contracts, peak in 2026, start to fall out to 2032, and then fall quite quickly down to 2041. In the absence of any new LNG contracts, we anticipate Australia having no LNG contract volumes by 2041. So what does this mean? It really means that Australian LNG exporters will be likely to seek new LNG contracts once the existing ones roll off. However, they'll be doing this in an environment with much more competition and likely with lower prices for LNG under LNG contracts. The prices under existing contracts, LNG contracts, could also be affected though. So long-term LNG contracts generally have what are called price review negotiation processes built within those. So every 5 years, the parties negotiate on a new price. And changes in market pricing can have implications. A recent example, Origin Energy recently announced that the price payable under APLNG's contract with Sinopec, which accounts for most of APLNG's LNG sales, recently fell as the result of a price review. So even though the LNG market is quite tight at the moment, the forward view is that prices will fall, and so the price under that contract has fallen. And this has an estimated cost to APLNG of about $2 billion over the next 5 years. The alternative to signing new contracts is to sell into spot markets, and without new contracts, Australian LNG exporters will be exposed to those markets. That brings along with it greater price volatility, but also greater price risk. It's much harder to hedge LNG spot prices than it is LNG contract prices. And that just reflects that the futures markets are quite different. So what does this then mean for the Australian market? And what are the interactions that we're seeing between LNG markets and the Australian market? So to set the scene, I think it's worth noting that actually the majority of Australia's gas production is exported. And this explains why Australia is such a large exporter, despite our reserves actually being quite small relative to other countries. Our reserves aren't in the top 10 globally. So using data from IEEMA, the energy market operator, and Kipler, we estimate that about 16% of Australia's gas production goes to the domestic market, but this doesn't include gas that's used in upstream oil and gas production, or gas that's used for LNG producers as part of their operations. That is captured separately down here. If you do account for all uses of gas domestically, including uses by the gas industry, that number goes up. And so the Australian energy statistics suggest it's about 20% of Australia's gas production is used domestically. Notably, when we look at the share that is supplied to the domestic market, even when we include the share that LNG producers use, that is actually less than what we sell or export to China, and it's also less than what Australia sends to Japan. So the domestic market is effectively the third largest user of Australian gas. Within the domestic market, what do we see? Well, we see that LNG producers are actually the largest user, with their use being about 3/4 of the amount that we export to Taiwan, which again is our fourth largest market. So the LNG industry in Australia actually uses quite a lot of gas. So if we dive a bit deeper on the East Coast, and we look at the impact of LNG markets, what we see is that Eastern Australia gas consumption, gas use, has fallen quite significantly alongside and during the period where LNG exports from Queensland started. And so we see that domestic consumption on the East Coast peaked in 2012, and by 2024, it was about 29% lower. If you use the Australian energy statistics instead, it's about a 32% drop, roughly over that period. This has also coincided with gas prices on the East Coast increasing. So this chart shows LNG netback prices as a proxy for domestic spot and contract prices. The relationship's not one-to-one, but the energy regulator provides some really great analysis on spot prices, and the ACCC, of course, provide analysis on gas contract prices. If we look at the sectors and look at which sectors have been hit the hardest, we see that electricity generation has had the largest proportionate fall. It's about 45% fall from 2012 to 2014. Industry has also been hit hard. When we look at, say, residential and commercial gas use, it was quite stable for quite a long period here, but has since started to fall. And that probably reflects, one, the impact of high gas prices following the energy crisis, but two, probably at the margin, some of the early wins from government policies around electrification starting to flow through. So if we contrast Eastern Australia's experience with that in WA, in Western Australia, what we see is that Western Australian gas consumption has actually increased over the past decade. So it's a very different picture. So gas consumption has increased, and this has largely been driven by large gas users. So really industry that we're talking about here. Prices have also increased quite materially on the West Coast, but of course nowhere near the levels that we've seen on the East Coast. When I was at the ACCC in 2022, we were seeing offers for gas supply above $50 a gigajoule. You can see that average prices, for instance, under existing gas contracts in WA are now at $6.50. And anecdotally, we know that prices for new contracts were marginally above $10, but again, nowhere near we've seen on the East Coast. In my view, this is undoubtedly due to WA's domestic gas reservation, effectively delinking international and domestic prices. However, it's not all good news. WA is showing signs of heading towards or heading in the direction that Eastern Australia has headed. The energy market operator is forecasting gas shortages in WA, and of course, prices have risen quite a lot. Domestic gas users are also becoming increasingly vocal about challenging market conditions in Western Australia, with warnings that it is following in the footsteps of the East Coast gas market. So moving on, if we take a bit of a step back and look at LNG projects in aggregate, what we see is that over the past sort of 6 years or so, LNG projects have achieved quite high utilization of their facilities. This is probably not surprising. LNG producers are resource companies, but they're also infrastructure companies. And any infrastructure worth it, any infrastructure operator worth its salt generally wants high utilization. So by 2024, we were seeing utilization above 90%, which is quite remarkable given there are two projects that have performed well below their capacity. That's Gladstone LNG, GLNG, which doesn't have enough gas supply, and Shell's Prelude facility, which has had some serious maintenance issues that has taken it offline for extended periods of time. Sitting underneath that is actually significant spot sales. So what we see is that utilization is being propped up by continued persistent and actually relatively high spot sales. In 2024, spot sales accounted for about 25%, slightly more than 25% of Australia's LNG exports. What this means, on the one hand, LNG projects have managed to increase their utilization. But what it also means looking forward is that there is scope here potentially for some of that gas to then be diverted back into the domestic market to help address gas shortages. IEEFA has done some analysis around this, and we find that diverting even small portions of gas that would otherwise be exported as LNG spot would help to alleviate the expected shortages. I guess just as just for anyone who's not used to the term LNG spot or not familiar with it, LNG spot sales really refer to discretionary LNG sales, i.e. sales that don't need to be made to satisfy contracts. And these are generally made on a very short-term basis. So if we come back to the East Coast, I spoke a bit before about part of the intention behind the tracker was to add to the evidence base to help inform the policy debate. There has been a bit of a narrative recently and a bit of discussion about the role of Queensland gas in meeting or addressing anticipated shortages in the southern states. And so I wanted to look actually at, when we look historically, what do we actually see in terms of some of the gas flows? And then, how does LNG netback, or how do LNG prices influence that? And so this chart shows net flows either into or out of Queensland. So a negative number is a net flow out of Queensland, and a positive number is a net flow into Queensland. And so what we saw during COVID, LNG demand fell on the back of lower industrial activity. LNG prices fell, and we saw additional gas being diverted into the domestic market, and a lot of that gas flowed south. And so we saw that Queensland was a net exporter of about 19 petajoules in 2020. But then in 2021, when LNG prices started to increase, and in 22, when LNG prices hit record levels, we see that actually Queensland was a net importer from the southern states, importing 16 petajoules in 2021 and about 25 petajoules in 2022. As LNG prices have then moderated, we've seen that reverse, and Queensland has become a net exporter again. The net flows south in 2023 and 2024 probably also reflect an increased need for gas from the southern states as well. Looking forward, if we see LNG prices fall materially, which could happen on the back of a supply glut, I would anticipate further gas flowing south. Given the prospect of gas shortages, though, there are also steps that governments can take to incentivize greater domestic supply. One option would be an export tax, and that is likely to be one of the least distortionary measures available. So moving on to my final slide, which goes back to WA. Apologies for taking you across the country and back again. What we see is that West Australian gas production has increased materially over the past decade, again on the back of the LNG growth wave, but domestic supply has not increased by the same proportion. And as a result of that, what we see is that the percentage of WA gas production that is supplied domestically has fallen quite a bit and has been below 15% since 2018. The reason I use that 15% mark in particular is because, of course, under the reservation policy, WA LNG exporters are required to supply 15% of their reserves, currently below that, and this reflects that many of those LNG exporters are behind on their domestic reservation obligations, according to the West Australia government. So that brings us to the end of the presentation.
Am I the only one experiencing a drop in signal or?
No, I can't hear him either.
Okay, well, that's good timing because that was the
Yeah.
end of Josh's presentation. He was going to show you a little bit the website and so on, but maybe we will keep that for later on, and we will shift to the Q&A part of the webinar. When Josh comes back, we will stop sharing his screen as well. But in the meantime, bear with us. Great. Well, I will now ask a few questions to our other gas analysts. So Chris Dolman is one of IEEFA's gas and energy specialists from our Asia team. And prior to joining IEEFA, Chris worked as a market analyst and energy modeler and spent 5 years at the Asia Pacific Energy Research Center in Japan. And Kevin is our energy finance analyst for Australian gas. Prior to joining IEEFA, Kevin worked for more than 30 years as a financial journalist for a range of publications, including the Financial Times and Argus Media, in particular covering the energy and resources sector. So I might start with Chris. Industry forecasts are generally very optimistic on future LNG demand, particularly in China and India, but not everyone agrees with them. For example, only recently, the head of the International Group of LNG Importers noted that future demand is uncertain. Can you reconcile these viewpoints, and what is your view on future Asian LNG demand?
Yeah, thanks, Amandine. Congratulations to the IEEFA Australian team on the release of the tracker, and thanks for giving me an opportunity to speak here today. So yeah, I think you could reconcile this cognitive dissonance that you're describing here by looking at the incentives of the LNG players, making the forecast, and contrasting that to what we're seeing like on the ground in Asia now. So industry needs higher LNG demand from emerging Asia to justify the large investments that they've made in their portfolios that are coming on stream this decade. So, but we're also seeing demand growth slow down in emerging Asian markets as they gain a better understanding of the high costs of integrating LNG into their energy systems. So Josh has already touched a bit on this, but industry consensus has been that we're basically entering into an LNG super cycle with capacity expected to export capacity rising 40% by the end of the decade, and we're going to have probably years of oversupply. And much of this export capacity is being purchased not by LNG consumers, but by traders looking to resell that LNG to consumers. Now, about half of the volumes purchased by traders remain uncovered by contracts with users. So in effect, you could interpret this as, again, traders trying to bet on their ability to make a demand market to absorb this offtake. So this is why you see Shell having a rosy, and other proponents having rosy demand forecasts. They're calling for Asia to play an instrumental role to lift LNG demand by 50% over the next 5 years, because they need that to happen, to justify the purchases that they've made. They need those to find a home. So yeah, I'd say though at the first 5 months of the year, Asian imports are actually down 7% in 2025. A lot of that is driven by China, where demand's down a quarter. Um, you know, uh, Part of that's weather, part of that's lower industrial demand, but I think we're also seeing China reveal some price preferences for the first 5 of the 6 months of this year. LNG prices have been, over $12 per MMBTU. And I think that suggests that Chinese demand growth may be conditional on LNG prices being below that. And I think Josh touched a bit on this, but we're seeing China also validate its energy security strategy. They're trying to limit their vulnerability to LNG imports due to high costs and the fact that some of the main suppliers are countries that have volatile trading relationships with them lately, like the US and Australia. So China can limit that exposure by leveraging cheaper energy sources, growing domestic gas production, pipeline imports, which are also growing, but also, coal production and, renewable deployment, that are, manufactured domestically. I think elsewhere in Asia, you're seeing like an emerging understanding that LNG could be unaffordable and a source of energy insecurity. It's denominated in US dollars, which, exacerbates affordability concerns when exchange rates, because exchange rates tend to depreciate during market turmoil. So when you need LNG, the most wealthier countries get a bid due. So what works for Japan, Taiwan, and Singapore and countries that wealthy isn't necessarily going to work for the less wealthy countries like Bangladesh and Vietnam, for example. So yeah, I think yeah, ultimately you're seeing aspiring users develop an understanding of the inherent risk of LNG to their energy system, and they're adopting a more cautious approach to planning that could become a tangible risk to LNG demand going forward. And I think that reality is clashing with the existential need that LNG suppliers have, which is, to resell their LNG to these markets at prices that are going to valorize their investments.
Right. Thanks a lot for that comprehensive answer. Another thing that I was keen to hear from you on is that we often hear in Australia that LNG is good for global emissions because it displaces coal in Asia. Can you tell us about what you see in Asian markets? Is LNG displacing coal?
Yeah, thanks for that question. Yeah, we hear that a lot in Canada too, where I live currently. We're not really seeing LNG displace coal in Asia. Like China and India are pretty illustrative. They're the two largest coal-consuming countries. In India, power executives say that they need LNG to land there at under $6 per MMBTU to compete with coal, or around $6 per gigajoule. So India's invested in vast amounts of gas infrastructure. However, much of it is laying idle. In the last fiscal year, 31 gas plants, about 8 gigawatts total, have generated zero electricity. In April, 5 gigawatts of those were retired. So we're actually seeing like stranded assets in real time in India because LNG cannot compete with coal or renewables. In China, it's very similar. China would probably need LNG to fall into the $5 per MMBTU range to displace coal. So yeah, what we're seeing also is both of these countries are turning to coal to provide flexibility and grid reliability to support their, rapid utility scale deployment of renewables that they're going to rely on to decarbonize their grid. So we're seeing renewables displace coal, not LNG. And I'd say outside the power sector, we're not really seeing LNG displace coal either. We're seeing some price sensitive use grow in sectors that are not using coal. Some of this is dependent on subsidies like urea-based fertilizers in India. But ultimately, you can't count what isn't there. Like what I mean to say is it's hard to quantify the benefits of coal displacement when the coal displacement isn't happening.
Well, thanks a lot, Chris, for clarifying that. And now I will be turning to Kevin and Australia. So, Kevin, the prospects of gas shortages on the East Coast have sparked renewed interest in gas reservation, which would mean redirecting some gas that was intended for exports from Queensland to the southern states. So, I'm often told that there's not enough infrastructure to transport that gas down. Can you tell us about your recent analysis on this issue?
Yeah, sure. Thanks, Emily, for the question. The plans in place on the East Coast. We've got APA, which owns a large part of the gas pipeline infrastructure on the East Coast. They have plans in place, fairly advanced plans at that, to expand their network by about 20%. And they operate the key pipelines that takes gas from Queensland down to the southern states. So if we look at that increased capacity with the diversion of the gas feedstock that was designated for the LNG spot cargoes, that would get us through from instead of the gas shortages that IEEMA are forecasting for 2029, that would take us out to 2032. So from 2033, that's there won't be enough capacity, but nevertheless, it still will make a big difference in the predicted supply gaps. So then the question could be asked, well, why don't we just send more down? Why doesn't APA expand more? Well, as Josh sort of mentioned in his presentation, we have seen declines in the East Coast gas market, and it's going to decline even further. So we're kind of looking at the period in the 2030s when we really will be dependent on those gas flows flowing from north to south. But by the time we get to the 2040s, gas demand will have fallen by such an amount that there'll be more than enough capacity in those expanded Queensland in those pipelines for the gas to flow from north to south. And so, sorry, if I could just add one amendment, there is a slight adjustment to that answer, because yesterday we had an announcement from the Victorian government on the gas demand measures. That alone would actually wipe out the AEMO's 29 gas shortfall. And it actually sort of takes us up to 2032, because the shortfalls, they're not looking at any shortfall in 2030, and 2031, 32 are sort of fairly small. So that initiative alone will take us out. So if we just amend that answer, it will actually get us to 2033. So really 2034 is a problem. And the reason being is that's when the Gippsland Basin gas, which is the dominant supplier to the Victorian market, that's when that's predicted to completely run out.
Great. Thanks a lot for that, Kevin. And one last question before we move to the audience Q&A. So get your questions ready if you have any. So Chris spoke about the coal to gas switching in Asia earlier. What are we seeing in Australia? Is gas pushing coal out of our energy systems?
Well, I'd have to give a similar answer to Chris. So in Australia, we've got two main electricity markets: the national electricity market, which is the East Coast, despite its name, and over in Western Australia, the Southwest Interconnected System. And both of those, we've seen a really big decline in coal. If we just take the time period between 2014 and 2024, so last calendar year. On the East Coast, we've seen coal power generation, its market share has fallen from 75% to around 55% at the end of last year. And gas has also fallen. So despite the steep decline in coal generation, gas has also fallen. And that's really because renewables have increased. What they have done over that same time period has increased on the East Coast from around 11% to last year up to around 39%. And so consequently, that's seen gas share fall from around 12% down to 5%. I've been rounding these numbers off, so if you're going to sort of calculate them, you might get to an odd number, but nevertheless, that's give you some sort of scope. And it's really a repeat on the West Coast, where you've seen coal power generation fall from a 50% market share back in 2014 to around 29% last year. And again, that's because of the renewables, and you've seen the gas share declined as well, and that's been extended into this year. You've seen further increases in renewable, further declines in coal, and further declines in gas.
Right. Thank you, Kevin. And so, as I just mentioned, it was now time for questions from the audience. So we've already had a number of questions, and I might group a few of them by topics. So there's a number of questions that related to the upcoming LNG supply glut. One question around how much do you think the US supply expansion is contingent on demand expansion? And another question that I might group with this on the impact of the increases in capacity on the Power of Siberia 2 pipeline, how that might shape the Asian LNG markets on top of the supply glut.
Well, I could I see there's also a question about what would happen to the U.S. domestic gas market. So I'm going to group that in and just sort of answer that first. Maybe I'll come back to the Power Siberia. But yeah, I don't really think you can quantify how much the expansion is contingent in the U.S. is contingent on demand expansion. I think we're heading towards the finding out period this decade because of the tension that I outlined, earlier. So like the tension being, to sort of reiterate, is that Asian demand is going to require lower prices for demand growth to grow at the speed that the LNG proponents are forecasting. Meaning you need something under $6 per MMBTU or lower. However, these new build U.S. facilities probably need a landed price of around $8 per MMBTU to break even, across the supply chain. So something has to give here to make this equation work. If Asia doesn't accept these prices, someone in the U.S. or across the supply chain anyway will need to take a haircut or a loss to continue the expansion, or maybe you'll need to see some cargo cancellations or whatever. But I'd say at the same time, we're seeing some potential for cost inflation that could exacerbate this in the U.S. You have demand for LNG exports rising. You have power generation expected to rise to fuel competing uses. Data centers are a pretty big topic right now, and that's likely to lift gas prices across the U.S. I also should say that there's, U.S. tariff policy is likely to be inflationary. Steel is an important component in LNG facilities and the oil country tubular goods that you need to line oil and gas wells. So the cost of producing gas and making LNG facilities could increase, which could increase the cost of gas, but also just, the fees that you need to recoup for an LNG facility. And we're already seeing some LNG producers renegotiate the terms of their contracts, looking for higher fees to cover rising costs before the Trump administration came on the scene again. Anyway, if this continues, I think we could sort of exacerbate this tension between, the price supply needs and the price that emerging Asia is willing to pay. And I think how that tension resolves will answer your question over the next decade. In terms of the power of Siberia, yeah, I think like we sort of touched a bit on it, but I mean that supply is cheaper than LNG for China. So if you're getting more of these pipelines from Russia or from other neighbors of China coming in, I mean that generally comes in at, I don't know, it's cheaper than LNG. I think it could be around $8 per MMBTU. It's not as cheap as what China produces themselves. But that would definitely, give them more room, to either resell their surplus, that they have of their contracted volumes, just like we're sort of seeing now. So yeah, that's what I'd say for that.
Thanks, Chris. And I might stay on Asian questions. There's a question around Japanese resales of LNG. So with decreasing demand for LNG in Japan, high Asian spot prices, do you see Japan playing an increased role as LNG trader by importing LNG from Australia? And I might hand over to Chris first, but then Josh, if you've got additional comments on the specific Australian.
Yeah, sure. No, thanks. Yeah, I mean, we put out a research, report on this a little over a year ago. Just talking about, the surplus that Japanese buyers have. So, I mean, with demand prospects have been falling since around 2014, following, the nuclear restarts that started to occur following Fukushima. There's also higher renewable deployment happening, and you have like demographic decline happening. So yeah, like Josh touched on it, but we've seen demand fall a quarter since 2014, basically. So most large buyers are behaving now like merchant utilities, reselling their surpluses to third countries and trying to cultivate demand to make sure that they can maintain those surpluses. So I think, basically Japan doesn't really need this LNG for energy security, but Japan's been the main character of the LNG supply chain for the last 50 years, and I believe, they want to ensure the security of their role in the LNG sector. So they're being instructed to maintain their handling at around 100 megatons and resell that surplus. And yeah, so that's really what we're seeing. I should touch on that, that research was done before Japan's seventh strategic energy plan. There's a few things that have changed in that. Mainly, electricity demand's a bit higher than it was in the sixth plan. And also, the seventh plan now accounts for the uncertainty in the energy transition, unlike previous plans. Basically, if Japan can achieve its goal of reducing emissions, I think it's around 73% below 2013 levels. I think they think that LNG demand could fall between 53 and 61 megatons. But if they don't progress as planned, if nuclear restarts start to lag, renewables start to lag, and that sort of thing, he projects that actually LNG demand could rise from 66 megatons now to about 74. So they're also instructing basically LNG buyers to purchase as if, to account for that uncertainty, as if LNG demand is going to rise a little bit to 74. However, I don't really think that changes our conclusions. I mean, 100 is still more than 74. There will still be a surplus going forward if that happens. So yeah, we still see these large buyers playing this role where they are reselling and trying to cultivate demand to develop a market for their resales going forward, no matter where they lie in that uncertainty range for Japan's LNG demand going forward.
Josh, did you want to add anything on the Australian side or move to the next question?
Look, I'll keep it short, but just to note that Japanese companies continue to invest in LNG projects in Australia. So we've seen this recently with Woodside Scarborough project, the Barossa field in offshore NT operated by Santos. So there is this long history of Japanese investment. We are continuing to see that, and I think that with that investment comes the potential for Australian LNG to continue to be sold into other markets.
Thank you. There's a couple of questions about the impact of the ADNOC bid to acquire Santos, and what impact it might have on LNG exports. Potentially, would they link disparate and uneconomical assets like the Beetaloo and Narrabri to increase their capacity? Or what impact would it have as well on the domestic supply? What do you think are some of the motivations between the bid and what could be behind the bid and what could be some of the impact on domestic and LNG markets?
Do you want me to take that one, Emma?
Kevin, do you want to
Okay.
go first?
Yeah. Thanks, Emma, for the question. Yeah, ADNOC, which is really the driving force behind this consortium bid for Santos. They've said with this XRG, this is the company they've set up, but that's really to expand their global LNG footprint. So really, they've revealed their motivation, and that is the LNG market. So I don't think the Australian domestic market is high up on their agenda. But nevertheless, given the political nature of this transaction, there will be talks with both state and federal government. So, there is a possibility that they could be doing something in terms of some of the domestic gas supply projects just to appease, political demands, I guess. But strategically, I think that their focus is the LNG market, and Santos not only has Gladstone and Darwin, but it also has a significant stake in the PNG LNG project, as well as the Papua LNG project, which isn't yet developed. So the PNG LNG project is actually their most profitable project. So that is quite a prized asset. So I think Narrabri as a standalone, there's a lot of questions about it, and I think also in the question there was a reference to the Beetaloo. I think that there's still a long way to go in the Beetaloo. That would probably, if it was economic, it would probably make more sense as an export project than supplying the domestic market, given the shrinking domestic market and the distance that gas is to where the consumers are. So it'd probably make more sense to send the gas up to Darwin where it can be exported.
Did you want to add anything, Josh, or should I move to the next question? Great.
Can I answer the one well?
Well, there's a few questions as well of the potential impact of the supply glut on Australia. So does the upcoming LNG supply glut bode well for Australian domestic users, or are LNG exporters still likely to be incentivized to export as much as possible into spot markets, is one question. And there's also questions about what are the implications for stranded assets potentially in Australia? Thinking of Barossa, Scarborough, and so on.
Okay, so I think does it bode well for Australian domestic users? I mean, I guess really the question here is how responsive are Australian LNG exporters to financial incentives and to differentials in domestic prices versus international prices. I think it's important to remember that most of the LNG projects in Australia are actually joint ventures. So we talk about Santos in, say, GLNG and Gladstone. I mean, Santos is less than a third. And so because these are joint ventures, it's not necessarily that financial incentives are the only thing that potentially might be considered, particularly given some of the JV partners are government-owned entities. They may have other goals in mind, such as LNG supply into their own countries. That said, I think that if we see an LNG supply glut, generally two ways to respond to that. One is to divert gas into the domestic market. The other is to lower your production, leave gas in the ground so that you can export that at a later point in time. Hopefully it would be the first, given potentially domestic shortages. And I think that really when we look at the industry and think about the industry social license, there is probably quite a strong argument for ensuring that Australian gas users have enough gas. Madeleine King, the Resources Minister, made this point a few weeks ago. In terms of implications for stranded assets, this is a really interesting one, and I've thought about this a bit in the context of Barossa. So it's hard to know exactly how much Barossa gas costs once it's liquefied. I saw some estimates suggesting it's about $6.50 per MMBTU. So another estimate suggesting it's above $12. So depending on where they sit, that could become a stranded asset potentially. It's more likely actually that Santos just takes a haircut on it. A good chunk of that gas has already been sold under contract. So I think it's less about stranded assets in the short term and more about actually financial returns and financial performance. In the longer term, absolutely, we could start to see stranded assets. Just looking up with the point earlier about Beetaloo, if we do see Beetaloo get developed and a new pipeline built to Darwin in order to facilitate exports, there is obviously the risk of that pipeline becoming stranded. Tamboran Resources, who are one of the main proponents in the NT, have proposed their own LNG plant. It's hard to see how that gets financed in. But nonetheless, if they were to build that, then yes, absolutely stranded asset at risk.
Thank you. Maybe just a very quick answer to one last question. Can you share your views on the need for gas import terminals in Victoria to deal with supply shortages? Who wants to take that one on for a very quick response? Yeah, Josh?
So sorry, I know quick response. I'll do my best. Really, this is also a question about financial viability, and really the business case, the financial business case for an import terminal. And so I think that part of the reason why maybe we haven't seen one come to market just yet is that really an import terminal would be looking to recover most of its costs in a fairly short period of time. Short in terms of a number of years, but short as well in terms of on a seasonal basis. So it's not clear exactly how much would be imported during summer, for instance. So we are likely to see it mainly in winter. I think it will be really interesting to see AEMO's next Victorian gas planning report and to see how much of an impact the Victorian government's announcement yesterday has on the risk of peak day shortfalls. But an import terminal, at least in the next few years, would really be addressed at peak day shortfalls. These are very short-lived shortages that could occur on the very cold days in winter in Victoria, like today, when people turn up their gas heaters. So look, remains to be seen, but I think that import terminals would have a fairly limited role in addressing shortages.
Well, thank you, Josh. And that closes the Q&A. And if you want to share your screen and show the tracker very quickly before we close the webinar.
Yes, and apologies for that. Every time it rains, my internet drops out. I used to joke that someone should regulate the internet. It was much funnier when I worked at IEEFA. Okay, so on the IEEFA website, simply scroll down, you'll find the gas and LNG tracker on our front page. At the moment, over time, that will likely migrate to another page. So maybe worth bookmarking. Bear with me, let's hope my internet works. So as I said earlier, the presentation that I just gave doesn't cover all of it. We do have quite a bit of analysis here. There are three things in particular I want to draw attention to. So the first is that we have some analysis on Japan in particular. So on the imports by country of origin, how much the demand has fallen over time, and then some high-level analysis on their onward sales, their third country on sales. We have some analysis on China. I covered some of that. But one part that I really want to point to is we have some analysis on the role of gas in the energy mix. So this provides some data to support Christopher's analysis. And finally, we have an appendix. It's buried down on the bottom of the page. I don't want anyone to miss it. And this just provides project level information on exports and project utilization over time. So, and that's it.
Well, perfect timing. We're now 1 minute before the end of this webinar. So I wanted to thank all of our panelists and everyone in the audience for joining us and sharing very interesting questions. And in case that's of interest, we will send you links to the recorded webinar, the tracker, as well as some of the research that was mentioned today. So have a good day, everyone.